Startups and small business. Do not forget to like, share, subscribe and ring the bell for more videos. Business owners use their own savings, loans, stocks and other sources for startup capital. It's vital to research your industry and make a plan that describes exactly how you can maintain profitability. Some people rush into growing a business without properly vetting out a strategy for long-term success. Pursuing an exciting business idea and not considering all the costs involved can make your dreams short-lived. Startup facts. There are more than 28 million small businesses in the United States. 1/3 of new businesses close within 2 years, and half close within 5 years. The Small Business Administration reports that around 10 to 12% of small businesses with employees close every year. After starting a business, the work has only begun. Staying competitive in your industry requires keeping an eye on trends and adapting to changing consumer demands. From evolving your marketing strategy to expanding your client reach, the work of maintaining a business requires constant dedication. Venture capital. One way entrepreneurs overcome their financial hurdles when starting out is by gathering venture capital, which refers to money from investors hoping to profit from partial ownership and the long-term, high-potential growth of new companies. This capital can be an essential tool for handling startup costs, as a new business's size, assets and development phase can prevent it from quickly growing. While banks may be unwilling to extend credit to companies without a significant track record or collateral, angel investors and venture capital firms are often willing to take a chance on a new product or service. If there is a convincing pro forma, a detailed plan for operating the business, then investors are more likely to take on the risk. Retirement. The sooner you start saving for retirement, the more opportunities you will have to grow the resources available to you. The average lifespan has been steadily increasing. In the United States, the average life expectancy is 78.74 years, World Bank. People are working later in life and living longer, both of which impact how much you will be able to save and how much you need to last your entire lifespan. Your personal savings account, bank, investment portfolio and employer can all be resources that help you prepare for the future. Retirement facts. The average age of retirement is 62. The average length of retirement is 20 years. According to the Center for Retirement Research, nearly 1/3 of all households nearing retirement have no retirement savings. Annuities and retirement. People interested in adding security to their retirement portfolio often turn to annuities, which they can purchase with one premium or with series of premiums. Insurance companies issuing annuities guarantee their payouts, hence the security appeal. The other retirement advantage that annuities have, their principal investment grows over time, and taxes get deferred until the investment starts paying out. The IRS taxes recipients on the annual distribution, rather than the value of the entire account. The secondary annuity market exists as well for people who want to shed their annuity or structured settlement immediately, instead of waiting on it to pay off years from now. This market allows annuity owners to cash out their contracts for money. The cash value for such a sale is less than it would be if an owner held on to the investment, but even those who once wanted a retirement investment find themselves needing money now and not later. For instance, some people need to pay off unexpected medical bills or family emergency costs. Others want to pay off student loans or are getting divorced and must make their long-term asset a liquid one. The seller can opt to sell some or all of their payments, using some money now and saving the rest for later income. Why an annuity for retirement? Anyone can buy an annuity, and you can shop among a variety of them. You can get a contract that sets up distributions to be paid out immediately, in several months or years or in many years in the future. Options include a fixed annuity, which provides a stable payout, or variable investment, which fluctuates based on market changes. Owners can also buy riders, such as the ability to make early withdrawals or the guarantee that payments last throughout the owner's entire lifespan. View our glossary of key annuity terms. Getting started. Begin by looking at how much you think you will need and planning a retirement budget. Fidelity Financial Corporation urges pre-retirees to have 8 times their annual salary saved by retirement. This general guideline can give you a rough idea of what you'll need, but to get a clearer understanding, take a look at each part of the picture. Questions to ask. What age do you expect to stop working? Do you plan to work part-time during retirement? What kind of pre-existing health concerns will you need to cover during retirement? What kind of retirement benefits does your company offer? Will your company provide you with a pension? These are just a few examples of the questions you want to answer as you put together a retirement strategy. Use resources like the AARP website to find calculators for estimating expenses. You can learn about topics like how inflation will impact the value of your money and how you can expect your health costs to increase with age. Do's and don'ts. Do consider downsizing and keeping the money you save to supplement retirement income. Don't forget about 401k savings when you move to a new job. Do decrease risks as you age, like moving from stocks to bonds. Don't put retirement savings as a low-level priority just because it seems to be in the distant future. Current assets. Icon computer. Next, look at the resources you already have. It's never too early to start a saving account. Even though your bank may offer accounts with low interest rates, you can use the decades between now and retirement to slowly build your savings. One way to guarantee you are dedicating a portion of your income to retirement is to set up automatic transfers straight from your paycheck into your savings. Get an estimate of your stock portfolio and how assets will mature by retirement age. Use tax-advantaged accounts such as IRAs and 401ks. If your employer offers a match plan, try to budget so that you can put in maximum contributions to get the most from this account. The value of 401ks has been increasing in recent years, in part due to the stock market. Looking into the future. Evaluate other sources of retirement income. The Social Security Administration provides an estimator for determining how much your monthly Social Security payments will be. You will notice that the longer you wait for Social Security payments prior to full retirement age, the more your monthly payments will be. If you're a veteran, teacher or other government worker, you may have pension payments you can count on. Your retirement benefits can greatly vary depending on your occupation and employer. Make sure you are aware of and participating in any employer-offered retirement plans. As you age, periodically gauge the value of your portfolio. You may need to adjust your funds, accounting for market lows or stagnant investments. The older you are, the more you will want to put money toward risk-averse investments like bonds, rather than fluctuating stocks. Additionally, if you fall behind in your retirement account deposits, you may qualify for larger catch-up contributions, which would typically be more than the yearly maximum. This guide can help you measure your savings progress. Timeline for retirement. At age 50. Begin making catch-up contributions, an extra amount that those over 50 can add to 401k and other retirement accounts. At 59 1/2. No more tax penalties on withdrawals from retirement accounts, but leaving money in means more time for it to grow. At 62. The minimum age to receive Social Security benefits, but delaying means a bigger monthly benefit. At 65. Eligible for Medicare. At 66. Eligible for full Social Security benefits if born between 1943 and 1954. At 72. Start taking minimum withdrawals from most retirement accounts by this age, otherwise, you may be charged heavy tax penalties in the future.